Deep in the heart of the financial system, a weapon has been armed. It's not a crash. It's not a recession. It is something far more permanent. We are living inside a quadrillion-dollar casino where the chips are fake, but your debts are very, very real. They call it the derivatives market. I call it the end of financial freedom.
While you work for dollars, they print billions to cover their bets.
The system isn't broken. It's fixed. And you're not on the winning side. Hidden dangers lurk in the fine print of a rigged economy. When this bubble bursts, the 2008 crisis will look like a dress rehearsal. It's time to see the invisible weapon pointing at your savings. Right now.
Did you know that right now, while you're watching this video, there's a financial weapon pointed directly at your savings account, your retirement fund, and your family's future? And here's the kicker. You probably have no idea it even exists. I'm not talking about inflation, credit card debt, or even the stock market crash everyone keeps predicting. I'm talking about something far more dangerous. Something operating in the shadows of Wall Street that makes the 2008 financial crisis look like a dress rehearsal. We're standing on the edge of a quadrillion-dollar casino, where the house always wins, and everyday Americans like you and me are holding the bag. You're probably thinking, a quadrillion? That can't be real. But it is. And the scariest part? The people running this scheme are counting on you not understanding it. They've built an entire economy on bets about bets, creating layers of financial derivatives so complex that even the so-called experts can't explain where the real money ends and the fairy dust begins. This invisible market is bigger than every single thing of value on planet Earth combined. Every house, every car, every business, every service, all of it. And it's not backed by anything real. Have you ever wondered why your dollar doesn't go as far as it used to? Why housing prices seem impossibly high? Why it feels like the system is rigged against ordinary people? Well, you're not crazy. It is rigged. And what I'm about to show you is the mechanism behind that rigging. Stay with me until the end, because understanding this derivative scheme isn't just about being informed. It's about protecting yourself from what's coming. The Federal Reserve, the big banks, and Wall Street insiders have created a structure so fragile that when it collapses, and trust me, it will, the bailout won't be measured in billions or even trillions. We're talking about printing more money than has ever existed in American history. And guess who pays for that? You already passed by this once in 2008, but this time, the scale is unimaginable. Before we go any further, I need to ask you something. If what you're learning right now is opening your eyes to how this system really works, do me a favor. Hit that like button and drop a comment below telling me whether you've felt this rigging in your own life. Maybe it's your mortgage, your grocery bill, or watching your parents struggle in retirement. Your engagement isn't just about helping this channel grow. It's about beating an algorithm that doesn't want this information reaching everyday Americans. The establishment media won't cover this because their advertisers are the same banks running the scheme. So when you subscribe and turn on notifications, you're joining a community that refuses to stay blind. Your voice in the comments proves we're not alone in seeing through this. Now let's expose exactly how they built this quadrillion-dollar house of cards. So here's where the transformation happened, where Wall Street stopped being about building wealth and became about extracting it. Let me take you back to understand how we got to this quadrillion-dollar nightmare. Originally, derivatives made perfect sense. Picture a farmer in Iowa back in the 1970s who plants thousands of acres of corn. He's got no idea what the price will be when harvest comes around 6 months later. So he signs a futures contract, agreeing to sell his corn at a fixed price. The buyer, maybe a cereal company, locks in their costs. Both sides win. It's real insurance tied to a real asset that actually exists. This was honest business. This was capitalism working the way it should. But then something sinister happened in the 1990s and early 2000s. Wall Street had a revelation, and not the good kind. They realized they didn't actually need the corn. They didn't need the farmer. They didn't need any real asset at all. They could simply create bets on the price of corn, then create bets on those bets, and then insure those bets with even more bets. This is where the scheme begins. Let me break down exactly how insane this got, because this is the hidden truth they don't want you to understand. In the old economy, you saved money, bought a house, and owned something real. Your mortgage was held by a local bank that had skin in the game. If you defaulted, they lost money, so they made sure you could actually afford the loan. But in this new financialized world, Wall Street doesn't care if you can afford your mortgage. Here's why. They bundle your mortgage with thousands of others and sell it as a security. Then they create a derivative that bets on whether you'll pay. Then another bank creates a synthetic version of that bet, which is basically a photocopy of a bet that has zero connection to your actual house. Then a fourth party sells insurance on that synthetic bet, and a fifth party bets against the insurance. You see what just happened? Your single mortgage just became the foundation for potentially millions or even billions of dollars in derivatives trading. And here's the kicker. If you pay your mortgage perfectly for 30 years, Wall Street makes money. If you default and lose everything, Wall Street also makes money because someone bet on your failure. They've created a system where they literally cannot lose, and you cannot win. This decoupling of the casino from the real economy is what experts call financialization. We moved from a market based on ownership of real things to a market based purely on speculation about speculation about speculation. It's like playing poker, except the chips aren't backed by money anymore. They're backed by promises about promises about promises. And the dealer is printing new chips every time someone runs out. Now I want to go even deeper into this, because what I'm about to show you is how they've turned your entire financial future into their personal gambling table. The derivative market today is estimated at over $1 quadrillion. To put that in perspective, the entire global economy, every single good and service produced on Earth in a year, is around $90 trillion. The derivatives market is more than 10 times larger than all real economic activity combined. These aren't investments in companies or innovation. These are bets disconnected from anything tangible. And when this house of cards collapses, the impact won't just hit Wall Street. It's going to devastate Main Street, your street, in ways that'll make 2008 look like a minor correction. The bastidors of this scheme reveal something even more disturbing. The same institutions that crashed the economy in 2008 with mortgage-backed derivatives are now bigger, more leveraged, and taking even crazier bets. They didn't learn their lesson because they didn't have to. They got bailed out. Your tax dollars rescued the very people who created the crisis, and they went right back to the same game, just with bigger numbers. If you're starting to see how rigged this really is, drop a comment right now and just write, "I see it." Let me know this is making sense, because what comes next is going to show you exactly who's pulling the strings and why they'll do anything to keep this scheme running. Now let me show you the psychological warfare they're waging against you, because this isn't just about numbers on a spreadsheet. This is about how they've weaponized complexity itself to keep you confused, compliant, and ultimately powerless. The beauty of this scheme, from their perspective, is that it's designed to be incomprehensible. When you hear terms like collateralized debt obligations, credit default swaps, or synthetic securitization, your brain naturally shuts down. That's intentional. They've created a language that excludes ordinary people from understanding how their own money is being gambled away. Wall Street tells regulators and politicians that these derivatives are actually making the financial system safer. They call it risk management, or providing liquidity to markets. They say these instruments spread risk around so that no single institution is exposed to catastrophic losses. It sounds reasonable, right? It sounds like responsible financial engineering. But here's the hidden truth behind that narrative. It's a trap, and it's based on a mathematical lie. Let me explain how they create leverage out of absolutely nothing. In a synthetic CDO, which is one of their favorite toys, no actual property changes hands. No real asset is bought or sold. It's pure abstraction. Money simply moves from one gambler to another based on a computer model's prediction about whether some underlying asset, which neither party owns, will go up or down in value. Think about that for a second. They've created $1 trillion market based on bets about things that don't exist in their possession, using money they don't actually have, backed by promises from institutions that are themselves built on promises. It's like creating a casino where the chips are made of IOUs written on other IOUs, and everyone agrees to pretend it's all real money. Now here's where the real deception lives, in something they call netting. This is crucial to understand because this is how they hide the true scale of the danger. The concept works like this. If Bank A owes Bank B $1 billion and Bank B owes Bank A $900 million, the banks and regulators only count the difference, which is $100 million, as the actual risk exposure. On paper, it looks manageable. It looks like the risk has been reduced by 90%, but that's an illusion, and it's an illusion that evaporates the moment things go wrong. Because when a crisis hits, when fear enters the system, liquidity disappears instantly. Suddenly, everyone wants their full $1 billion right now, not the netted $100 million. It's like a game of musical chairs where everyone realizes simultaneously that there aren't enough chairs, and they all rush for the exit at the same time. In those moments, gross exposure is what matters, not the fantasy math of netting. And the gross exposure in the derivatives market is so massive that no amount of money printing could possibly cover it. When the music stops, and it will stop, we're not looking at a financial crisis. We're looking at a liquidity black hole, a moment when the entire system freezes because everyone demands payment simultaneously and discovers that the money they thought existed was never really there. Your bank account, your retirement fund, your ability to access your own money, all of it depends on the collective agreement that these paper promises have value. The mentality shift that happened on Wall Street is this. They stopped thinking about building real value and started thinking about extracting maximum profit from an increasingly abstract system. They don't care if you understand it. In fact, they prefer that you don't. Your confusion is their competitive advantage. The more complicated they make it, the harder it is for regulators to oversee, for journalists to explain, and for citizens to demand accountability. This is why after the 2008 collapse, nobody went to jail. How do you prosecute someone for fraud when the entire system is so complex that even the people running it can barely explain what they're doing? They hide behind jargon, behind armies of lawyers, behind the claim that everyone was doing it, and the models said it was safe. But the models are garbage. They're built on assumptions that only work in stable conditions, and they fall apart instantly the moment stress enters the system. Yet these same broken models are still being used today to justify even bigger bets, even more leverage, even greater systemic risk. The revelations keep getting worse the deeper you look. The derivatives that crashed the economy in 2008 were primarily tied to mortgages. Today, derivatives are tied to everything: corporate debt, commodities, currencies, interest rates, even the weather. They've turned every aspect of economic life into a betting opportunity, and the stakes keep growing because the system requires constant growth to survive. It's not sustainable. It's not even rational. But it's incredibly profitable for the people at the top, right up until the moment it all implodes. And when it does, the impact won't just be financial. We're talking about a complete loss of faith in institutions, in currency, in the social contract itself. If you're starting to feel the weight of how serious this really is, type "This is bigger than I thought" in the comments below. Now I want to go even deeper into this because when you see the actual numbers, the scale of this fraud becomes undeniable. Let's talk about the math, and I'm warning you right now, what I'm about to show you is going to make your stomach drop. The global economy, meaning every single good and service produced by every country on Earth in an entire year, is projected to be around $117 trillion in 2025. That's everything. Every car manufactured, every house built, every haircut, every meal served, every software program sold, every medical procedure performed. The total productive output of human civilization, $117 trillion. Now, keep that number in your head and let me show you something that should be illegal. The over-the-counter derivatives market, according to the Bank for International Settlements, which is basically the central bank for central banks, reports notional values exceeding $800 trillion. But here's where it gets even more insane. That's just what they're willing to report. When you include the shadow banking system, the off-balance sheet exposure, the synthetic positions that don't show up in official statistics, credible estimates put the total derivatives exposure at over $1 quadrillion. Let me make this crystal clear. The financial bets being placed right now are 7 to 10 times larger than the actual economy those bets are supposedly based on. Imagine if you made $50,000 a year, but you had gambling debts of $400,000. That's the ratio we're dealing with on a global scale. This isn't finance anymore. This is a Ponzi scheme dressed up in a three-piece suit. And the transformation that's happened is this. Wall Street has convinced everyone that these numbers are normal, that this level of leverage is just part of modern finance, that this is how sophisticated markets operate. But it's not normal. It's insane. Warren Buffett saw this coming 2 decades ago. Back in 2002, long before the financial crisis, he called derivatives financial weapons of mass destruction. Those weren't just dramatic words from an old investor trying to get attention. That was one of the most successful investors in human history, someone who's made his fortune by understanding how markets actually work, warning the world that we were building a doomsday device. And what did we do? We ignored him. The banks kept creating more derivatives. The regulators kept looking the other way. The politicians kept taking campaign contributions from the same institutions building the bomb. And now, here we are, 23 years later, and that weapon of mass destruction is exponentially bigger, more complex and more dangerous than it was when Buffett first raised the alarm. The decisions being made in boardrooms right now aren't about your financial security. They're about extracting maximum short-term profit before the whole thing collapses. Think about what this means in practical terms. If even a fraction of these derivative contracts go bad simultaneously, there isn't enough money in existence to cover the losses. The Federal Reserve would have to print tens of trillions of dollars, maybe hundreds of trillions, just to prevent a complete systemic meltdown. And when they print that money, when they flood the system with dollars to bail out the banks again, what happens to the dollars you already have? They become worth less. Your savings get diluted. Your purchasing power evaporates. You didn't make any bad bets. You didn't create any synthetic CDOs. But you'll pay the price because that's how the system is designed. Now here's the part that should terrify you even more. The interest rate hikes we've seen over the last few years, the Federal Reserve raising rates from near 0 to over 5%, that's lit the fuse on this bomb. Higher interest rates mean the value of existing bonds and debt instruments drops dramatically. And guess what derivatives are often based on? Bonds and debt instruments. So right now, as we speak, banks and hedge funds are sitting on massive unrealized losses in their derivative portfolios. They haven't admitted it yet because accounting rules let them pretend everything's fine as long as they don't sell. But the truth is, hiding in the shadows, waiting for the moment when liquidity dries up and everyone has to reveal what their positions are actually worth. The giornata we're on right now is toward an inevitable reckoning. The only question is when, not if. Some analysts think it could happen within the next year. Others think we have a few more years before the system can't sustain itself anymore. But every expert who's actually looking at the numbers honestly agrees on one thing: this ends badly. The impact when it happens won't just be financial markets crashing or banks failing. We're talking about potential disruptions to basic economic functions. Your ability to withdraw cash from an ATM. Your ability to use your credit card. Your employer's ability to make payroll. The supply chains that bring food to grocery stores. Everything runs on the assumption that the financial system works, and when that assumption breaks, society itself starts to fracture. This isn't doom and gloom. This is just acknowledging the mathematical reality of a system built on exponentially growing debt and leverage that has no connection to actual productive economic activity. If you're realizing just how fragile everything really is, drop a comment and write, "The math doesn't lie." What we need to understand now is who actually profits from this casino, because this isn't some abstract financial phenomenon affecting everyone equally. There are clear winners and clear losers, and I'll give you one guess which category you fall into. Follow the money, and the truth becomes obvious. In the United States, Just 4 banks control nearly 90% of the entire derivatives exposure. We're talking about JP Morgan Chase, Bank of America, Citigroup, and Goldman Sachs. These institutions generate absolutely massive fees from derivatives trading, collecting billions upon billions of dollars in profit, while simultaneously creating the systemic risk that you, the taxpayer, will be forced to absorb when it all goes wrong. They've constructed the perfect scam. They get the upside, you get the downside. But here's where the revelations get even more infuriating, and this is something most Americans have absolutely no idea about. There are provisions in the U.S. Bankruptcy Code called safe harbor rules, and what these rules do is genuinely criminal in spirit if not in letter. If one of these major banks fails, if their derivatives bets go so wrong that the institution becomes insolvent, the derivatives counterparties get paid first. Let me repeat that because it's important. The other financial institutions that made bets with the failing bank jump to the front of the line ahead of you, the depositor. They get paid before regular customers can access their accounts. They get paid before the FDIC insurance fund kicks in. The people who created the problem get made whole while ordinary Americans who did nothing wrong watch their money disappear. This is written into law. Congress put this in place after lobbying from the big banks, and it's been sitting there waiting to transfer wealth from Main Street to Wall Street the moment the next crisis hits. Think about the mentalidad behind this for a second. The entire justification for these safe harbor provisions was that derivatives are so important to financial stability that we need to make sure those contracts get honored first. Otherwise, the whole system could collapse. But that logic is insane. It's like saying we need to pay the arsonist before we help the people whose houses burned down, because otherwise the arsonist might get upset and burn down more houses. They've literally written laws that protect the gamblers at the expense of everyone else. When you deposit money in a bank, you think it's your money sitting in an account with your name on it. But legally, the moment you make that deposit, it becomes the bank's money and you become an unsecured creditor. You're just another person in line hoping to get paid if something goes wrong. And thanks to these safe harbor rules, you're not even at the front of that line. The derivatives traders are. So while you're standing outside a locked bank branch trying to figure out how you're going to pay your mortgage or buy groceries, the hedge fund that made a $10 billion bet with your bank is getting a wire transfer for the full amount. The bastidors of how this system actually operates would shock most people. These banks don't just hold your deposits and make loans anymore. They've become highly leveraged gambling operations that happen to have a retail banking division attached. The checking account you use to pay bills is just a side business. The real money is in derivatives trading, and your deposits are part of the collateral pool they use to make those bets. You didn't agree to this. You didn't sign up to have your life savings used as chips in a quadrillion-dollar casino. But that's exactly what's happening, and it's all perfectly legal because the people running the casino wrote the rules. Now let me show you just how concentrated this power really is. These 4 banks aren't just big, they're systemically important, which is a polite way of saying they're too big to fail. The government has already signaled that if these institutions get into trouble, they will be bailed out no matter the cost, because letting them collapse would supposedly take down the entire economy. But here's the twisted logic at work. By guaranteeing these bailouts, by creating this implicit safety net, the government has given these banks permission to take unlimited risks. Why would they be careful? Why would they manage risk responsibly when they know that profits are private, but losses are socialized? They have every incentive to make the biggest, most leveraged bets possible, because if they win, they keep the money. And if they lose, you pay for it through inflation, through bailouts, through the devaluation of your currency. This is the hidden truth that keeps the entire scheme running. It's not capitalism. It's not a free market. It's a wealth transfer mechanism disguised as banking, exactly as the script says. They've created a system where a small number of institutions can extract enormous wealth from the productive economy without actually producing anything of value themselves. They're not building factories or inventing technologies or creating jobs. They're shuffling paper, making bets and collecting fees while the real economy, the one where people work actual jobs and create actual value, slowly gets hollowed out. The impact of this isn't just financial, it's corrupting our entire political system. These banks spend hundreds of millions of dollars on lobbying and campaign contributions. They fund think tanks that produce research justifying their behavior. They hire former regulators and offer them seven-figure salaries, creating a revolving door where the people who are supposed to be protecting you are really just auditioning for their next job on Wall Street. And when crisis comes, when the derivatives bubble finally pops, these same institutions will demand another bailout, and they'll get it. Because the alternative, they'll tell us, is complete economic collapse. They've taken the entire country hostage. If this is making you angry, if you're starting to see how rigged this game really is, write "they rigged it" in the comments. Now let me show you something that might actually give you hope, because I'm not just here to scare you. I'm here to help you understand how to protect yourself from becoming collateral damage in this derivatives nightmare. The truth is, you have more power than you think, but you need to make some fundamental decisions about how you interact with this broken system. The first step is declaring your independence from the casino. That means conducting an honest audit of your actual exposure to this derivatives scheme. Start by understanding something crucial that banks will never tell you outright. The money in your checking and savings account isn't legally yours the moment you deposit it. You've essentially loaned that money to the bank, and you've become an unsecured creditor, hoping they'll pay you back when you ask for it. Most of the time they do. But in a crisis, when liquidity evaporates and safe harbor provisions kick in, you're at the back of the line. So ask yourself, how much of your wealth is sitting in accounts that could be frozen or bailed in if one of these too-big-to-fail banks suddenly isn't too big to fail anymore? The transformation in mentalidad you need to make is this. Stop thinking of banks as safe places to store wealth and start thinking of them as counterparties in a transaction who have their own interests that don't align with yours. This doesn't mean you pull all your money out tomorrow and stuff it under a mattress. It means you diversify your exposure and reduce your dependence on institutions that are over-leveraged and playing with fire. One of the most powerful moves you can make is shifting some of your wealth into hard assets, specifically physical gold and silver. Now I know what you're thinking, because everyone's been conditioned to mock people who talk about precious metals, right? But here's why gold and silver matter in this context. They have zero counterparty risk. If you own physical gold, it doesn't matter if a derivatives contract blows up on the other side of the world. It doesn't matter if JP Morgan's synthetic CDO portfolio implodes. Your gold is still gold. It can't be inflated away by money printing. It can't default because it's not a promise, it's an actual asset. Throughout human history, when paper currency systems have failed, and they always eventually fail, gold and silver have maintained value because they're real, tangible wealth that doesn't depend on anyone's promise or anyone's solvency. You don't need to go all in on precious metals, but having some portion of your savings in physical form, stored securely outside the banking system, gives you insurance against systemic collapse that no FDIC guarantee can match. The hidden truth here is that the wealthy already know this. Central banks around the world have been accumulating gold for years. They understand what's coming even if they won't say it publicly. The second principle of resistance is direct ownership and radical simplicity. Avoid complex financial products that you don't fully understand. If someone is offering you a yield that seems too good to be true, and they can't explain in simple terms exactly where that return is coming from, run away. There's a saying in finance that's absolutely critical. If you can't explain the yield, you are the yield. You're not the customer, you're the product being sold. This applies to structured notes, to exotic ETFs, to high-yield bonds from companies you've never heard of, to cryptocurrency schemes promising guaranteed returns. The more complicated the investment sounds, the more likely it is that you're on the wrong side of the transaction. Stick with things you understand. Direct ownership of dividend-paying stocks in companies that produce real goods and services. Real estate that you can touch and see. Businesses that generate cash flow from actual economic activity, not financial engineering. The system is leveraged to the absolute hilt, which means the best resistance is to be unleveraged yourself. Own things that are real, not paper promises. Own things that exist independently of the financial system's stability. This is how you create actual security in an insecure world. Consider also reducing your exposure to the largest banks. Look into credit unions or smaller community banks that aren't playing the derivatives game at the same scale. These institutions are boring, and boring is good. They take deposits and make loans to local businesses and homeowners. They're not trying to create synthetic CDOs or trade interest rate swaps. Your money might earn slightly less interest, but it's also not being used as collateral in a quadrillion-dollar gambling operation. The jornada toward financial autonomy isn't about getting rich quick. It's about building resilience and reducing your vulnerability to systems you can't control. It's about making decisions today that your future self will thank you for when the crisis hits. And it will hit. The math guarantees it. The only question is whether you'll be positioned to weather the storm or whether you'll be completely exposed when the derivatives market finally implodes. This isn't paranoia. This is pattern recognition based on how these cycles have played out throughout history, just on a much larger scale this time. If you're committed to taking back control of your financial future, type "I'm taking action" in the comments. Look, if you've made it this far, you're not here by accident. You're part of a small minority that's willing to look at uncomfortable truths instead of just hoping everything works out. Most people will never watch a video like this all the way through because it challenges everything they've been told to believe about how the financial system works. But you stayed. That tells me you're serious about understanding what's really happening and protecting yourself from what's coming. We are living through a historical anomaly. A quadrillion-dollar bubble built on leverage, speculation, and paper promises cannot exist forever. The laws of mathematics and economics don't care about political spin or media narratives. This will correct. And when it does, we're looking at the biggest liquidity injection, the most aggressive money printing operation in human history, just to prevent total systemic collapse. The question isn't if, it's when. If this video opened your eyes to something you didn't see before, do me a favor and hit that subscribe button right now. This channel exists to follow the money and expose the mechanisms that mainstream media won't touch. Every video I make is designed to give you the information you need to make better decisions for yourself and your family. Drop a comment below and write "House of Cards" so I know who actually made it to the end and who's paying attention to what's really going on. Your engagement helps this message reach more people who need to hear it. And if you found value in this, hit the like button. It takes 1 second and it tells YouTube that this content matters, which means more people get to see it before the algorithm buries it. Now, if you want to know exactly when this derivatives bubble might break and what the warning signs will look like, I've got a video breaking down the outlook that connects all these dots. Click it right now and keep going. I'll see you there.